Welcome everybody. Thank you for coming on this warm, I think one of the first, no, not the one of the first, already we had some really warm days, hot days already here, like today. So we put the air conditioning on this morning, and I know for the ladies over there, it's maybe if it's getting too cold, let us know, then we switch it off, okay? Or we do it less cold. Thank you again for coming. Thank you, John, coming over especially for you from Denmark to give you a really in-depth presentation about the economy. And the economy, of course, is really broad. So John will talk about currencies. He will talk about unemployment rates, about products. A really broad story. I think really interesting. Again, really in depth. First of all, I want to say a little bit about who we are. A lot of you I'm happy to know already. My name is Casper Huisman. I'm working in this field for more than 25 years. I started in the Netherlands. I'm from the Netherlands. I know you can hear that. I started with the first online broker. And then I moved in 2007 to Spain to set up the first foreign branch of that broker. And that broker was bought at the end of 2019 by Saxo Bank. So we were partners, we were colleagues for a couple of years. And then last year, by the beginning of last year, we became independent, like an independent broker, and Saxo Bank is our partner. So that's why we are really close, a good relationship with Saxo. So we help each other where we can. So that's why John is here to talk to you as a joint client. This is our name, and when we started our own company, we had to apply for a license, and we thought, okay, and our lawyer also said, you have so much experience, it will take you 3 months, maybe 4 months, because it was still the COVID, so things would take a little bit longer. At the end, it took us 1.5 years, because it's getting nowadays a financial license in Europe is extremely difficult. But up front, I think the name was I thought the name would be the most difficult thing, because if you decide on a name, you can't go back. You can't change a name. Yeah, you can, but it's not really, I think, not really sustainable. And why we chose Hugo, because the first online broker that I just mentioned was called Alex. That was what I said in late 90s, because we want to have a personal approach. And by using a first name, it's even more personal than a lot of banks back then were called Labouchere, Stroever. They all had really chic first names, sorry. And if you read it like this, Hugo Investing, it directly says, okay, what do you do with us? We are the only one on the whole strip here from there to there that are not into real estate. We are a financial broker, and this is you. You are the client, and you are really central place with us. So we also can say, I think, and the client that knows us, we give you private banking services for brokerage prices. I think in this slide, everything comes together, I hope. So how's the setup then with Saxo Bank? So we are like a white label partner of Saxo Bank. We use their systems. We use their bank account. Because Saxo has a bank account. So all the clients with us, they have a bank account in Denmark. So really safe banking environment. And so we give that to the clients, the bank account system, and above, on top, we provide service and education. And I think we're going quite far in that. The license, we are an agencia de valores. And if you don't speak Spanish, that means that we are a broker, a financial broker. And we are the only one in the Costa del Sol. Of course, all the banks, the Santander and the Bank Inter here, they also have their licenses to give you banking services and brokerage services. But only the specialists, there's only one specialist here, because of that are we. And I hope that you agree that if you want to do something that's really important, you go to a specialist, no? So if you go to us, I think you go to a specialist. And the last thing I wanted to say is that the education and the service is going really far. We made online courses. We built them in the last 3 years. And we built courses for all the products, the financial products that are in the market, CFDs, Forex, bonds, shares, and on different levels. So we have programs for starters, for experienced investors, and we also have packages. And together with the university in the Netherlands, we have even created a short master investing, and that is all the knowledge and everything that we know that we put in there. So that's a course really intensive, and it takes half a year. We have courses that take a couple of weeks, a couple of months, but this is the top, but everything is in there. There's a short master investing. We're really proud of it that we developed it together with the university. So that's a little bit about us for the people who don't know. So I now give the floor to John. Again, John, thank you very much for coming. I said up front, we had a couple of conversations that the people that you will see here, they are quite well sophisticated with their investments. So John took that in mind and prepared a really intensive and hopefully interesting story. I know it's interesting. So thank you again, John.
I hope it's
the floor is yours.
Thank you. Thanks very much, Casper. I'm sorry if the reality doesn't quite fit the nice picture, but I think there's some degrading in the hair going on there. This is a very recent picture, so there's no excuses. Yeah. Okay. So who am I? I'm John Hardy. I've been with Saxo for about 20 years. My glasses are crooked because of this microphone. Studying, or not studying, but talking about FX. So the FX strategist for Saxo for the better part of 20 years, and I'm also head of the strategy team at Saxo. My presentation today, I'll be talking very, very broadly because I understand you're a pretty diverse audience. I didn't want to focus too much on one thing, too much on FX. The nice thing about FX is that you have to look at everything anyway. You have to look at the global macro picture to understand, or to try to understand what's going to happen next. So these are some of the things I'll be walking us through, just about everything in short. And I think this is a really interesting time for me to be presenting because I think I've never seen an environment with so many people that I respect, so many of my heroes throughout the years that I've followed that have, looking forward and saying, okay, what's going to happen next? Are we heading into a recession? Are we about to hit a rough patch in the markets? What the hell's going on? I've never seen so many diverse opinions from some very, very, very clever people. And I think some of you who maybe read some of the more clever people out there may know what I'm talking about and feel the same way. So we'll try to be looking at a number of things today. Where are we right now in the markets? Where are we right now in the economy? That's the first part. Some perspectives on the US dollar, the be-all and the end-all of currencies. If you know what the US dollar is doing or going to do, you're pretty well along the way to knowing a lot of other things. Although sometimes when the dollar is quiet, then other things are going on. The Japanese yen, one of the main question marks hanging over the global markets is what the hell is the Bank of Japan going to do and when? We need to understand that and what the impacts might be. And then a very, very sort of conceptual framework about this whole question that asked 5 times a year by journalists. Is the dollar losing its status as the global reserve currency, and is the dollar doomed? Some thoughts on that. As related to that, partially geopolitics, extremely important about why inflation is not going to go down, why it is here to stay for possibly for decades, but at least for many years to come. And then since it's such a bloody hot topic, we can't not talk about AI. I'll have a very few slides on that, just some perspectives, and so that maybe, Casper, you can pass on some of the stuff we've written and done on AI, these theme baskets and some of the pieces that my colleagues have written. And even a few thoughts on options. So you're here for 4 hours, right? So first, okay, this recession, we've been saying is 100% odds of recession for quite some time now. Is it here? Is it now? Is it next? Is it never? When is it? What are we looking at to see where we are in terms of recession? Very important question. One thing we can look at is something like the yield curve. So this green and then now red line is the yield curve, and whether it's steep or inverted. The steepness, when it's steep, that means the Fed is stimulating like crazy, very low rates relative to the longer end of the yield curve. When it's inverted, that means you have the front end of the yield curve. There's no secret now. The Fed is at 5+% with its policy rate, and the long end of the yield curve is very well anchored below 4% at the moment. Huge inversion, the most inverted yield curve since the early 1980s. That's has a very good record, the yield curve, when yield curves invert, of calling recession. but very, very inexact on the timing. And generally there is some kind of lag period. So if we look in the past, you could argue the lowest point of the inversion was maybe 8-9 months before a very mild recession started in 2001. Back before the global financial crisis, you had a mild inversion. Its maximum point was in late 2006. We weren't really in trouble in global markets till late 2007. There are plenty of signs of other things going on before then. The economy itself was not even suffering until well over a year later. So have we even reached the low point yet? That's an open question. So we could be talking about a lag of at least, let's call it two to 3 quarters, and possibly another year plus before we're in a recession, according to this. Another thing you can look at, and it very much follows the yield curve, is something like the expectations versus present situation component of consumer confidence. And so here I've mapped the difference in blue, and you can see how sometimes it leads, sometimes it lags what the yield curve is doing. Here it kind of led. The most recent cycle, it led the yield curve inversion because the Fed was very, very late to get started with its tightening because the economy and markets were roaring. Normally, you would expect for people to start feeling some kind of suffering in their present situation before you're actually in a recession. That's not happened yet. The expectations are low, but they're not collapsing just yet. So we're somewhere, we're heading towards this recession, but we don't know the timing here. Long story short. We're looking at incoming indicators. We're desperate for those because it feels like the Fed has stopped this whole business with, remember, forward guidance was so key during the global financial crisis for guiding markets. What's the Fed going to do now and in the coming quarters? This forward guidance game is over with. The Fed is simply reacting to incoming data. So we have to know what the incoming data is if we want to know what the Fed is going to do. It's almost more important to know the data than to think about the Fed. So people are trying to get, all the way down to weekly claims, trying to get excited about a couple of weeks of these rising. It's been a very unreliable data series, lots of revisions. Yes, it is rising. Okay, maybe there is some loosening going on in the labor market. But from a long-term perspective, it's still extremely tight, the jobs market. So jobless claims relative to the last 20 years here, we're still at very, very low levels. You can see it in things like the average weekly hours coming off. But are we just back to normal? Because this was just about not enough jobs or not enough labor, so we're having to use the labor we had and more intensely during the huge boom as the pandemic stimulus came through. It's a trend, but it's not at worrying levels just yet. And same with the payrolls. So the payrolls are on a declining basis, but you can still have an extremely tight jobs market with payrolls that are half of what they're coming in at this point. So it's not really, and it's a lagging indicator anyway, it's not something that's flashing warning signals. Things like these soft surveys, the ISM services, it gets headlines, ooh, supposedly getting close to recession, but another one, the S&P is saying, actually, this is the best we've been doing for 12 months. There's a lot of confusing data out there on these soft surveys. No good conclusions there. Yes, some loosening in the jobs market, but still very tight. And then there's the banking sector that caught us all off guard in March. The huge turmoil in banks in the U.S. Suddenly, the front end of the U.S. yield curve collapsed. Oh my gosh, the banks are all going under. It's a new stimulus cycle, and we're heading straight into a recession. There's going to be a credit crunch. We kind of actually went a little bit too far in that direction ourselves, figuring that this would bring forward the recessionary risk. And it has brought it forward from whenever it's going to be. It probably has come forward because of increasing credit crunch. So never before have we really seen that deposits are leaving the banking system. This just doesn't happen really, and it's a concern. However, look what happened here. This was pandemic stimulus. So just to sort of get back to trend, we could still lose another several $1 trillion out of the banking system, and we're just back to trend. So it is a directional pressure on the economy. It is costing banks more. They're going to have to start paying their depositors for their deposits now. They were actually, even as the Fed was at 4 and even 5%, they're paying depositors 0 on a demand deposit, checking account, savings account. They're going to have to start raising those rates, and that costs banks more. That means the credit will be reduced. And the blue line here is, this sort of shows what's happening. So instead of the money going into banks, it's going into treasuries. It's going to money market funds, so they can at least earn something like the Fed's policy rate. And so we're talking about, wow, we're at 5%. We haven't been at 5% since back just before the global financial crisis. Surely this is a tight Fed, and the economy must really be suffering. This is a great perspective here from this Bob Elliott, pointing out that in past cycles, for the Fed to be tight, you had to be at least, let's call it 5% above PCE inflation. At present, that would be a policy rate of 9%. I don't think we're going to 9%, but is 5% enough for the Fed to get its job done? Arguably, in past cycles, let's say that's not a very tight Fed yet. And then we all got a little bit excited about, this is too complicated, I won't go through too much of this, but there's this enormous amount of liquidity going in and out of the system from the US Treasury, especially on the pandemic stimulus. So the Treasury raised almost $2 trillion to spend into the economy, fearing that it was going to have to support the economy, and the Fed had bought all this, so this is no big deal, to stimulate the economy. And then we got through the pandemic, and then it said, you know what, we don't need to be sitting here on $2 trillion. We'll stop raising so much money, and we'll spend the money out into the economy. So if you recall, 2021 was a spectacular year for global markets, because when the Treasury is spending money, that's just money flowing straight into the economy. It's just like it's like steroids into financial markets. Liquidity, liquidity, liquidity. And maybe not a huge coincidence, of course, the Fed starts hiking here, but also the Treasury at the same time was building back up its account after draining it down towards zero, raising its account back to these levels. That was an especially vicious period. I'm sorry, that's the opposite. It's here when they're drawing it back down again that is the worst part. They have the Fed hiking and then the Treasury drawing down its liquidity. Anyway, they added more than 900 in liquidity, 900 billion during this period, which is actually, in other words, the Fed was trying to sort of pull out liquidity from the market and tighten policy with its QT, which is selling bonds back into the market. And that was actually overwhelmed by the Treasury's adding liquidity during this period. So we haven't really had a tight Fed from a quantitative perspective yet. And the fear was, now that we're past this so-called debt ceiling, it's a long story, that they would have to once again rebuild the liquidity, which puts pressures on the market. And the Fed will be doing QT again. Yes, it's a concern, but there's always many ways to look at liquidity. And then this Fed has this other facility called the reverse repo, which is this thing, which is $2 trillion. There's more liquidity that can be drained out before there's a problem. So the reason this built up was that there weren't enough T-bills for people to have, so people were borrowing from the Fed basically to get the liquidity from the Fed. So now you have basically $2 trillion that could be drawn down without any issues for liquidity. So this whole liquidity angle has just not been a factor that it was supposed to be, and it may not become a factor. Oddly enough, as well, you had all these pandemic rescue plans, et cetera, et cetera. The American Rescue Plan was one of them. We think, okay, this money got spent in 2020. The Fed spent 100 billion-ish on this or that. But all it did was get allocated. There are many local City Hall here, Boys and Girls Club, this, that, and the other. They're sitting with these funds. They haven't even used them yet. And this is still stimulus. There's still stimulus coming into the economy from pandemic. Regardless, the market seems to think it knows more seems to have a very strong forecast of what's going to happen. And what I'm showing here is how it's sort of predicting the economy by predicting what the Fed is going to do over the next 2 years. So these are all the different short-term interest rate contracts. This is the present one with a policy rate on 5. They're expecting maybe a little hike, and then the Fed's going to start cutting. So these are cutting rates. So all these contracts out into the future, all the way out to March of 2025, are the markets pricing in Fed cutting. So down to about 3.5% by the early 2025 timeframe. Now let's come down a little bit. They were expecting more cuts. Below 3% Fed funds rate was being predicted after the banking turmoil here. But the market is starting to lose a bit of confidence on the Fed cutting, but it's still predicting a pretty strong cutting regime, and this recession is going to allow this sometime early next year. But the Fed has not won the fight against inflation yet. So the market thinks it will. The market thinks that inflation will go down to 2-ish% over a 2-year, 5-year, 10-year horizon. Inflation is not going to be a problem, says the market. That's why that long rate, the 10-year rate, whether it's in Europe, whether it's in the US, has stayed very anchored. And that anchoring, together with all this liquidity that's still in the system, is what allows this new speculative bubble we've seen to develop. So even though the central banks are tightening, it's only tightening at the front end. The more important rates are at the long end, especially for equity market valuations, and that's allowing this new speculative bubble to develop, or strong equity market if you don't believe it's a bubble. And I just ended the presentation. Other types of measures that we used to traditionally look at, do we need to worry about a credit crisis? They're not showing any signs of concern at all, especially back before the global financial crisis. There was a screaming credit crunch that was just galloping month after month, way before the global financial crisis hit. Part of that was because you had an extremely large and liquid market driven by these, I would call it gunslinging gangster investment banks that were leveraging up their balance sheets and were trading all this stuff back and forth, knowing that things were getting a bit dicey. Now this is all being held in pension funds and sovereign wealth funds and things like that. So you don't get the market pricing in credit like you did back in the day. So this is just a non-indicator anymore. Regardless, it's just not showing any signs of pain. This is credit, so a junk bond ETF. Yes, it went down when yields went up, but it's been pretty stable. And the credit spread, so what you pay, what you yield from this debt, has actually been improving lately. So credit standards or credit measures are improving. No signs of pain in credit, no advanced warning signal there. So one of the few places we are seeing pain is in real estate, and especially commercial real estate. You can see something like an office because of changed working behaviors, post-pandemic, etc. People's usage of offices, especially in the US, is lower. So these places are showing pain. There's a lot of concern in the private equity space. Here's a big one that just marked its value down 23 billion in 1 year. By the way, this was an interesting single story. San Francisco specifically, there's a building supposedly worth $1.5 billion, a hotel, and it doesn't say who the owner was. I forgot who the owner was. But the owner of that hotel had $750 million of debt in a property supposedly listed at $1.5 billion. They walked away from it. So in other words, the property is worth far less than $750 billion. So those are the types of property value impacts in some of the hardest hit commercial real estate spaces. Probably not Marbella. Some very specific things with San Francisco, but it just gives you an idea of some of the dynamics in some of these spaces. Yes, there could be some trouble from specific players, especially in private equity, but it's not registering in broader concerns. And it's not just the U.S. I focus on the U.S. because the U.S., regardless, and that's not because I'm American, but it's the most important economy for the world because of the dollar and because of the Fed being the world's central bank. But it's fairly similar in the rest of the way around the world. So you have European banks, the permanently sort of just not destroyed, but the huge hit taken in the global financial crisis because Europe decided not to recapitalize its banks like the U.S. did. And locally here, you can see that they're starting to come under pressure relative to the broader market, which is continuing to go higher. Yield curves also inverted, whether it's Germany, also going further afield. If you go to Australia, their yield curve is finally inverting. So we're all sort of getting there towards this signal almost everywhere in the world. There are a couple of exceptions where the pain is much harder because of specifics in the economy. One of the most interesting is Sweden, which is almost a laboratory for a private debt bubble linked to housing. Their currency This is the Swedish krona versus the euro. It just collapsed to a new all-time low today versus the euro. Household lending is collapsing. They're on very short-dated mortgages, sort of floating rate mortgages, and these are rolling to these new higher interest rates. And even a policy rate of 3% or slightly higher there is doing this to the economy, specifically in Sweden. So it's a very different situation from the US, which has 30-year fixed mortgages. It's not feeling any pain unless you need to go buy a new house. Somewhat similar for Canada, although they do have 5-year rates. So the 5-year will start rolling in when these guys start rolling in that took out yields, mortgages at 1%, are rolling into, let's call it 4 or 5%. Okay, so that's a little background on where we are with the economy. We're not very wise on that we're necessarily going to hit a recession right now. And there could be the risk that central banks have to tighten more. Now I'm going to talk a little bit about what to look at. If you're not familiar with FX, or even if you are familiar with FX, you need to know what's going on with the dollar, if something is going on with the dollar, because it's the most important financial asset in the world, that and US Treasuries. And I like this model here that somebody's come up with. I don't know who coined this term, but it's called the US dollar smile. And what it means is that there are a couple of types of situations that drive a stronger dollar. Quite different ones, actually. Although sometimes they can be doing the same thing at the same time. First of all, and very recently, we saw a very strong economy in the US, which is pushing the Fed to raise borrowing costs, and especially if they're doing so aggressively. It sounds like 2022, right? Stronger dollar. Pretty straightforward. The other side of the dollar smile is safe haven demand. When the economy is seen rapidly deteriorating, but not just the economy, but financial markets are seeing a lot of turmoil and volatility. Because assets globally are predominantly denominated in dollars, it's the most important currency, so the dollar can go up when the world is in pain. And if you want to see it in action, you can see some crazy gyrations in the dollar. This is a euro versus the dollar, by the way. The green, so a little bit confusing. Strong dollar is when euro dollar is going down. There were some crazy things happening there. In November of 2021, Powell and Brainerd accepted their nominations to become Fed chair again, Fed chair and vice chair. And they made clear that they were going to be all about fighting inflation. And they jacked the policy rate up. This is the 2-year yield, which anticipates before the Fed actually acts. And that huge hike, the big Fed rate hike, is coincided with the huge euro-dollar collapse. Pretty straightforward. There was the addition of Russia wanting to invade Ukraine, which made the euro situation worse. And then you can see as the momentum came out of the US yields, that's where you're starting to find the bottom in euro-dollar. And then there was one last sprint higher in Fed rate hike expectations, one last push lower in euro-dollar. But it was less about a huge secular move, so it didn't have as much impact. So what happens here? This is this euro-dollar falling, the green again, euro-dollar falling. And this orange line. Now, bear with me. It's basically just the difference between European yields and US yields. But I add a little bit of something in that I put that 2-year yield differential or spread out 2 years. So what is the 2-year yield going to be in 2 years? And you see that there was no relationship here between this orange, these yield spreads, and the euro dollar. That's because it's all about the Fed hiking. When the Fed is got its foot on the gas, that's all you need to know. Once markets calm down, and I put this big arrow here because there was a huge collapse in the volatility in equity markets, and fear levels dropped a lot. And once fear levels dropped, then the whole dollar focus eases a bit. And then something like, okay, well, now that the Fed isn't such a massive focus and we're not so afraid of the Fed, maybe we can look at something else. Like maybe, what is the ECB doing? And the ECB indeed was coming late into the cycle and saying, oh my gosh, this inflation is a problem. We need to hike rates and hike them a lot more than we have so far. So then we start focusing on what's the ECB doing, and it's doing more versus what the US is doing. And that correlation gets established. But as soon as there's drama in the markets, as soon as there is Fed providing drama with new policy moves, then this correlation will probably
fade away again. All right. Are we surviving so far? Okay. The yen. Tough one here because you have a world that is moving very, very swiftly on with massive policy moves, massive policy tightening. And here's Japan just saying, nope, we're going to stay put. We're not going to move our policy. And it creates these, does anybody remember the Swiss franc revaluation in early 2015? At that time, you had an ECB that had never done the proper easing that was required to support its banking system and to support its economy. And was getting ready to do massive quantitative easing. The Swiss National Bank was just sitting there on that ceiling and saying, we're not going to move, we're not going to move, we're not going to move. And then one day they say, okay, we're going to move. And there was all hell to pay because there were all kinds of leveraged bets on that they would never move. There is a similar dynamic here with the Japanese yen. So somewhere out there, I'm not saying it's the exact same situation. Japan also has very deep resources. They hate volatility. They don't want to give up on this policy like that and create a huge market event. But the longer this goes on, and especially if we start a new upswing in global yields that continues to push that spread wider between Japan that won't move and the rest of the world that is, it's creating a bigger adjustment event when it finally does happen. I'm sorry about this slide. It's not very nice, but on your eyes. But the general idea here is here's this same 2-year US yield. So the massive Fed rate hike. When does dollar yen peak? Does it peak when short yields peak? No. It peaks when the long yields peak in the US. So the long yields are paramount, especially because the Bank of Japan doesn't just control the short rate. It's still at minus 10 basis points, by the way, if you can fathom that. It says that the 10-year rate cannot go above or below 0.5%, the other side of zero. Right now, that's 0.5%. So as long as it's stuck there, and as long as rates go higher, and as long as the Bank of Japan is not expected to do anything, this stretching continues and continues and continues. They have a new governor, Katsuo Ueda, if I said his name correctly. His first meeting was in April. He said that we need some time here. We're not sure about this inflation thing, if this is really happening or not just yet. Yes, we've had the highest inflation in a generation, but we're not sure that this is sustainable. So we need to study the situation before we decide what to do. And we need up to 18 months before we decide what to do. The markets were really disappointed, and that's why I've seen this recent very powerful weakening in the Japanese yen. And I would argue it's also a significant driver of this recent global rally in equities. It provides lots of liquidity. Liquidity when you have a very large economy continuing to just powerfully ease in this environment. So they're not sure about inflation yet in Japan. This, by the way, that was a sales tax increase that came into the picture and then faded after a year. Sales tax increase that faded after. So those didn't really happen. I don't know. No, that was the 80s. So that's the last time inflation was near here. So they haven't had inflation this high in a generation, over a generation, 2 generations arguably, but they're not sure it's happening yet. So they're going to wait. Anybody detect some sarcasm? Please let me know. But the funny thing is, so the market has gotten a little bit excited about this big Bank of Japan adjustment that is coming, and has tried to sort of not place bets, but just sort of show a little signs of fear here and there, but not really. And this is the what the heck is this one? This is the a measure of the options skew in the market. So dollar yen options. What it means is when what happened here. This is a global financial crisis. This is when you have a crisis. Traditionally, the Japanese yen goes straight up because everybody's been enjoying selling yen when times are good, and they need to repatriate. The Japanese investor needs to repatriate to Japan when times are bad, and people need to unwind their so-called carry trades when global markets are in turmoil. So you get these crazy options skews because people know that if the yen is really going to move, it's going to move down, or sorry, up. But the dollar yen and other yen crosses will move down if there's a panic.
But and then we had in 2012, late 12, early 13, we had the new Bank of Japan Governor Kuroda at the time, where it was all about crazy, massive new QE to drive the yen lower. So it actually, for the first time really ever, the skew became for dollar yen calls instead of dollar yen puts. Long story short, there's no fear in the market right now that there's any imminent adjustment coming. There is a Bank of Japan meeting in July, so might be worth looking into, but maybe not. It's hard to read into what the Bank of Japan is thinking here. I would expect you would see some more signs of fear. But it also means with, I didn't put the implied volatilities in here, but it's relatively cheap to continue to speculate in the continued weakening of the yen via yen cross call options. All right, this is a really difficult subject, but I think it's worth a mention just to put it out there if you start to see different behaviors in the market. My favorite slide, and probably my dumbest slide because it's not very self-explanatory. So here's the worry, what do you call it, the Cassandra warning on the dollar. The dollar is, there's a structural problem with the dollar. That means that the dollar eventually is doomed as the global reserve currency. It's a pretty easy argument to construct. It goes along the lines of the U.S. is issuing too much debt that it cannot pay via Fed tax revenues. In the end, if you have a U.S. government that is running irresponsible policies of spending, so this is actually old. I couldn't find a good one that's newer because it's worse now than this graph shows. But basically it says that here are federal revenues-ish as a percent of GDP. And here we have sort of so-called entitlement spending, so just the basics of Medicare, Social Security, and medical care for the poor, together with what it costs to service the U.S. debts. And with interest rates rising, of course, this section is going much rapidly higher. And this was back in 2015 or 17 when this was made. It's even worse now because interest rates have gone up a bit more. It's saying, all of Fed tax revenues are just going to be going to this stuff within, let's say, a few years. So, it's unsustainable. Look what Trump did. Trump lowered, he created a worse deficits at a time when the unemployment rate was improving. In other words, you're at the top, you're going towards the top of a cycle. Things are better than ever, and then you make your deficit situation, your debt situation worse. Complete insanity, right? So irresponsible. It is insanity. The dollar didn't pay much for that either. So he's saying, look, these kinds of dynamics. This is a guy that's sort of leading this type of research and discussion of this. The debt spiral, the dollar's doomed, all this stuff. And he says it's going to end up with, the U.S. being forced to do like the Bank of Japan, sort of say, look, we can't afford these high interest rates. We're going to cap them at this level because eventually long-term U.S. rates are going to go to 10% and it'll be a debt spiral, right? And that'll mean nobody will want to buy U.S. Treasuries. If nobody wants to buy U.S. Treasuries because they don't have the appropriate yield, the dollar is doomed. Well, so far, it's not looking too bad. I mean, this 10-year yield, right? It's less than 4%. Where's the panic? This is not a secret, this story, right? Why are we at still such low rates for longer-term U.S. Treasuries? And why? This is indirect bidders for U.S. Treasuries at auctions. Why are they more popular than ever, U.S. Treasuries, among foreign bidders? If we are in a debt spiral, we're all doomed, right? So something is wrong with this story as expressed in the market. It's not working, at least not yet. They'll say, it's just not yet. They're gonna, it's next year, it's next year, it's next year. And here's the guy who's going to tell you why it's not working and why the dollar actually, if you look at my little clever, I thought it was clever, is the dollar a currency that's doomed to fail? Or is the dollar the currency that is dooming the world or the world financial system to fail? And that sounds very dramatic, and there probably is some drama that awaits us at some point. So he says, yeah, okay, well, there's always this talk about the dollar is being maybe used a bit less in terms of trade invoices. So you see stories like Saudi wants to trade oil directly with China, no dollars involved. Russia, China, transactions, maybe some India, Russia oil transactions, etc. So as people stop using it in invoices, they don't need as much currency reserves. So if the dollar is being used less, then it goes down in terms of its value because it's less desired to build up currency reserves, etc. But Mr. Brent Johnson, worth a guy listening to. I'm fully taking sides on this. I think there are aspects that both sides say that are true. The question is what happens. He says it doesn't matter all this other stuff because the key here is that so much of global assets and global debt are denominated in dollars. And those assets need to be serviced in dollars. Other currencies won't do. And that's why the dollar goes up, the dollar smiles when you have a global crisis. And there's even the central bank of central banks, the so-called Bank of International Settlements, in December sent out a sort of a warning call that there's something called FX swaps, which are basically ways to service U.S. debt that you don't want to put on you don't have to put the FX swap on your balance book, on your balance sheet. These FX swaps suggest that there's $80 trillion of this U.S. denominated debt out there in non-banks outside of the U.S. and in non-U.S. banks. So both banks and non-banks outside of the U.S. $80 trillion, that's 80% of global GDP. So his long-term thesis is that eventually this whole system is creating this swelling of forever swelling number that just boggles the mind will eventually get the world into trouble because we're just going to need to see some kind of reset. Because who are these people out there that are holding these tens of trillions of dollars of assets? I think a lot of them are in Asia. And what's happened so far is that we get the pandemic, we get the global financial crisis, and the Fed just sort of opens up all these swap lines with foreign central banks. It doesn't even know what it's covering or what these swaps are being used for. It just does it to stop the system from showing pain. But eventually this stuff gets too big or they have to investigate under the hood what is going on. And I think the thing that drives the risk is something like the separation, which I'll get to next. I hope it's next. The attempted separation of the Chinese and U.S. Sort of economies and financial markets.
I have one question.
Yeah.
So now I think the debt in percentage against GDP of the US is around 122%. And it increased from 60 last year, I don't know, decade. But when will it be a real problem? When it hits 150% or 130?
I don't have a number. I don't know. It depends what the interest rate is. As Japan showed, you can get it up to some number that's called 250%.
Yeah. And
it's still not an issue because rates are non-existent. So servicing debt, especially when the Bank of Japan owns half of it, you're not, as long as the central bank is doing quantitative easing, there's no number. You can do the math on if you know that interest rates are going to be 5%, they're going to stay there, and that all the Fed's debt is going to continue to roll into 5%. You can do the math on when that starts to become a problem. What it means is you'll need to have nominal growth extremely high to prevent that from being a huge real load on the debt growth. But that
from that point of view, you want to have lower interest rates. But now
from that point, or do you want to have higher nominal growth? That's higher than the interest rate. That's what I think is going to happen. So financial repression. In any case, I think he's worth a follow, and it's worth just tracking this as a source of it, and just observing what happens in the markets if turmoil ever does return again. And I think it will at some point. And I'm not here to be right about this or wrong about this or to sow fear. I just think it's a very interesting existential question for global financial markets that has to be addressed within my lifetime, I would hope anyway. And you see some pressures on China as well. I think something very odd is going on in China. I think their economic model is broken. And so there's talk of Chinese stimulus, but it has to be very piecemeal because their economic model was essentially local governments getting revenue by parceling out land in this massive property bubble around that process. And they can't restart it because property values have already gone up to ridiculous levels, and they've created, together with all of the other leveraging up and borrowing and spending in the Chinese corporate sector. So get this, corporate Chinese debt is worth $57 trillion. So 200% of US GDP is the supposed value of corporate debt in China. That's why the stimulus is not going to come in sort of a meaningful way in China. And you have a CCP that seems to want to sort of go Maoish on policy and support state-owned enterprises. There's a lot of tensions there, and this whole, what I'll get to next, which is geopolitics. And I think that it's the geopolitics and what we call fragmentation of the global economy, not deglobalization, but sort of every country trying to carve out its sphere of interest and friendshoring and reshoring so that it's not too reliant on any other region, that is also going to start stressing this whole dollar reserve question, especially, and it's also going to drive inflation. If you really want to get into the weeds on this, check out this guy. He did a series of papers on, what was the series of papers called? It's basically about a series of papers that was inspired by what happened after Russia invaded Ukraine and basically cut the cheap Russian natural gas link to Europe and especially to Germany. And it's behind this whole fragmentation idea as well. So the argument is, after the pandemic and the disruptions it gave the global economy, you can't have, the U.S. can't have that. It realizes that suddenly we can't make cars because of some cheap microchips that are made in Taiwan, which China may invade. These supply chains have to be in friendly hands or our own hands. Europe, we can't buy natural gas from somebody that's invading, putting a hot war in Europe for the first time since World War II. We need more secure energy supplies, and they can't be from Russia. We need to rearm. We're vulnerable. Europe basically has no military. We need to reshore to make more robust supply chains. We do that with industrial policy. We're seeing industrial policy on a scale we've not seen since World War II, as we realize it's not just about military, but it's about the interests of our entire economy and society, to put our economies on a war footing from the sense of we need to be self-reliant. So we need to rearm, we need to reshore our supply chains, we need to restock and invest in commodities if we don't have secure access to those in friendly hands, and we need to do this energy transition because we're cooking the planet. So it's a slightly big fiscal ask, I would say. The government has to do a lot of spending. Somebody has to do a lot of spending to get us there. This is inflation. War, whether it's trade war, whether it's a war of just making sure you're secure. I don't mean war necessarily as a hot war. It always has been the source of inflation. It was the subject of our last quarterly outlook, and we just identified, for example, some key sectors that are relevant for this fragmentation game theme. Obvious stuff: defense, electricity, renewables, and nuclear power. That's a tough one to invest in, though. Technology, semiconductors, AI and batteries, physical infrastructure. And then you see some really remarkable speeches coming from somebody like Christine Lagarde, saying that, look, we need to stop doing central banks in a fragmenting world. We can't do like in the pandemic. If there's a new crisis, we just sort of shower all this money on the economy, and it just creates inflation just to keep people's nominal wages up. It just creates activity for activity's sake. There's no intent or outcome that's productive. We need to make sure that money goes to the climate change agenda, or it goes to this, or it goes to that, along the lines of these supply chains, commodity supply chains, product supply chains, semiconductor supply chains, et cetera, et cetera. I'm running on a bit, so I think I'm going to blitz through the last few of these a bit. But just to raise some thoughts, and we can take it up in the Q&A. All right, is it okay? Yeah. Yeah, so we've had also in Europe, so why is Europe managed so well? There are two reasons. They spent a hell of a lot of money to ensure that there was never going to be a gas storage, a catastrophe in heating, for example, last winter. And it was blessed with the warmest winter in Northern Europe in whatever, a generation. And gas is running above, storage levels are running above the year range this winter, are heading into the fall as well. We got some prices that were, if we're talking about normal, quote unquote normal is something like the 25 euro range for Dutch gas. We got 10x that for spot contracts at times. Now we're almost back down. We are basically back down, or have been back down to historic ranges. But that's just an artifact of a temporary, very, very strong supply situation. The strategic, having, as he says here, you had, $2 trillion worth of industry that had a pipe from Russia stuck in it that you'd pay $20 billion of gas to get $2 trillion of industrial output on the other side. If you're replacing that Russian gas with LNG from Qatar, with LNG from the US, it's just going to cost you a lot more. So if you look at the year forward levels for power, they're actually still something like triple of what the normal range was. So there's a huge challenge for Germany and its industrial model. It's still an open question mark. Special challenge for Germany. Global spending on military, is at a fraction of what it was. Hopefully we're not going back to the Cold War, but at least we could see it rise by 50%. Maybe in terms of priorities, maybe we ought to do ammunition for Ukraine instead of TikTok videos for electricity usage. That was a interesting article there. The analysis of the semiconductor thing is fascinating with Taiwan producing so many of the chips. There's huge spending and focus on that. Semiconductors are extremely strategically interesting, critical. European Chips Act, the US Chips and Science Act, too much of it in Taiwan and hard to replicate because it's almost magic that some of these factories, what they can make. And you're seeing the spending on this just going up. This is the spending long term in the US on manufacturing. It's just, nothing going on. And then you're seeing the huge focus on chips. Some more, even Intel. So Intel was given, very unlike Germany. Germany gives away 10 billion euros to Intel to build a plant. Also needing it. And then they can stop some of the trade with China. They don't want China to suddenly become reliant on China instead of Russia for cheap solar, because is China our friend? We can't just replace one foreign reliance with another. How do we get solar ourselves? Commodities too cheap. And then there's in this new environment of inflation and fiscal dominance, and government setting the agenda for where we spend, argues Posar, and I largely agree that this 60-40 way of portfolio investment doesn't work anymore. 60 equities, 40 bonds. He suggests 20 cash, 40 stocks, 20 bonds, and 20 commodities. And arguably, when stocks are too high, some more cash to be ready when to rebalance when the expected returns are better. Interesting way to look at it. AI, $200 billion day for NVIDIA on one quarterly guidance number because it was so shockingly high. It's a massively interesting area, but already it seems to have rocketed into bubble territory, arguably on valuations. I mean, it's valuations unlike we've ever seen from a large company. NVIDIA has hit 40 times sales recently. It's completely impossible numbers. The growth requirements required for that to be a win from these levels just would be unheard of and completely unheard of for a company of its size. It's not to say AI won't change the world. The internet changed the world as well, and most of the world that it changed was after 2001 when the bubble popped, similar to railroads. But this is kind of scary to our minds. And one of the interesting test cases, so the contrast between NVIDIA is and AMD it's like the gold mining rush in the U.S. Or anywhere in the 19th century. Who are the guys making money? Are these the guys that are chopping rocks out in the next to the water and busting their backs? No, it's the guy at the store that's selling the shovels. So the shovels in this case are the NVIDIA chips, the AMD chips, and that is it's a reasonably logical approach to go for the shovels, the shovel makers. An interesting test recently was the Adobe. So Adobe has some special new AI-driven stuff. You can just say, take this image and make it, I want to make it look like it's the lighting in a cafe, and so I don't know. I don't know exactly the particulars, but it's some amazing new features that people are really impressed with. And it rose, 50% on the AI angle. But this is an end application rather than the shovel angle. And I was actually quite underwhelmed by their forecasts and the result, which it's not showing up yet. So it did correct after the earnings report. It's just maybe an interesting story to track the end use people, the ones that have the actual applications for generative AI versus the people that are being forced also to invest in the NVIDIAs of the world to drive AI, if that's what's needed to keep their products competitive. The most interesting aspect of all this to me is longer term, what it could mean for driving further disruptions and even inequality in income spectrums. So this was a recent McKinsey study made. I always have to take that with a grain of salt, but that they argue before generative AI, these for jobs that did not even require a high school degree, current technologies could basically replace about 54 of that. With generative AI, they could replace a bit more. So the delta there is not huge. But as you go up the difficulty levels, you're talking about suddenly, very high level, very highly educated people risking disruption from AI. So it's a very fascinating thing to watch in coming years if that proves to be the case. Very good question. I don't know. This was taken from an article without context. It'd be very easy to Google this report. There was a very big splash that made this report very recently. So I think it was probably 10 years or something like that. And it makes sense. I mean, there's some things like translating text, composing articles. I even used, anybody used ChatGPT for something productive, actual in use for anything? I had to write a job description or a job opening description. And I was like, oh God, I've never even written one before, really. And I'm sure there's some boxes I should be ticking with. I need to think of this angle, that angle. So I said, hey, help me out with a job description. It needs to be, I work for this company. This is the kind of stuff we do. This is the kind of stuff the strategists we would be hiring would do. It came up with a brilliant job description or a job ad for me that I just sort of tinkered with. I mean, that probably saved me 2 hours of work. I mean, the productivity is mind-boggling for certain applications for this. And could it just mean, like somebody said, I heard an IT guy say, well, it doesn't matter, if it makes a computer programmer, 3 times more productive, it's going to be 3 times more programming. Because we're just limited now by the number of programs we had, so it was just going to up the amount of programming that's going on and saves the less sophisticated stuff. The AI can do it for you. And we've got some thoughts. You can look, I guess you'll pass around the presentation, and you can have a look at some of these specific names, which I won't go into. One question is, can we store all this crap that we're producing, and can we, is it worth the energy spend if we're going to be worried about our climate? Here's some estimate. I don't even know where this is from, but it's just the numbers are just so absurd. It's crazy. So internet. So even this is just connected devices. So what do you call it? Devices on the internet. The connected internet could create something like 175 zettabytes. What does that number even mean? So I just sort of said, okay, what is that relative to Facebook's database? It'd be 600,000 Facebook's worth of data. Do we have the electricity to run that? Maybe not. So there could be some limitations, some real world limitations on even something like AI. Just a thought. Internet connected devices, I think it's called. That's assuming there are 5 for every person. Do we have time for options? A couple minutes. My only point in the options, I'm not a huge options person. I look into it quite a bit. I understand a lot of the principles of options, I feel. But just a couple of perspectives of things that are interesting, I think, that are going on in options. So, of course, people see something like this. From the short side, you would obviously want to be short this instrument. It looks great. This is the VXX, by the way. It's an option strategy. So if you're trying to be long volatility, this is the kind of returns you might see using this ETF, a very crappy ETF to be long over time. And you get volatility spikes, and the market always seems to show that if you can just hold out for the tip of the spike, you're really good for selling volatility. There have been some big resets in options pricing. So here was the huge overuse of options and got too much leverage in the system. Then you have what's called the apocalypse. You had a reset of the VIX range higher for a long time. Pandemic, everybody lost their minds. The VIX range reset higher once again. And then, even though we've had a bear market, the volatility just has not been there to justify the options premium. So it's been a very good period for selling options, extreme options anyway, during this bear market and depending on the instrument. And it does appear that the VIX range is resetting back lower. The danger in options, no secrecy. You can't have unlimited downside risk. This was the famous XIV that failed basically in one day after a 500% return back in the apocalypse of 2018. I suspect what happened back then, there was a big destabilizing rise linked to one option strategy, and then that killed the opposite option strategy when that came under strain. Always be suspicious if you see any instrument that has this type of return profile. Steady grinds, option selling, and then big adjustments, big adjustments, big adjustments, and then, oops, very big adjustment. Even the most famous traders in the world have been wiped out by this stuff. Niederhofer is a famous trader for George Soros, famous case. It's not to put fear in your hearts. I'm just saying we have to be aware of the return distributions when we take unlimited risk. And I suspect, and just a specific warning on options, this so-called 0 days to expire phenomenon. What does it mean? And I don't know. I've seen two of the most famous options gurus with different conclusions on what's going on. It aggravates volatility. No, it doesn't. It suppresses volatility because people are selling. I just think it's remarkable. This is the call option volume. In general, I guess, yeah. But most of this is 0 DTE. In other words, 0 days to expire. They're opening a position on something that expires on the same day. And it happened, what supercharged it was when all days of the week were made available for S&P options. I think it's a volatility risk when you see volatility getting extremely compressed. They've even come up with a one-day VIX, if you can believe that, to help track these things. I suspect that we're getting into the risk-reward area, starting to get a bit dangerous on selling options. You see these crazy spikes, those are US data releases. People know there might be some volatility, so they do stuff. On those days, 50% of the market, and even single stocks are driving huge feeding frenzies on Fridays. What is this? Yeah, call trading volume on Fridays. So they don't do anything all week, and then they wait till Friday, and they have some fun day trading the 0 DTEs. I'm sure there's some very profitable strategies there. I'm also sure there's some risk involved. I don't have time for I like this discussion, but it's ways for structuring options trades around big events like Brexit. But I think it's getting a bit too into the weeds on that one. So I think I'll ease up on your brains a little bit and see if you have any questions for me or thoughts. I'll even take a complaint or two if you have any of those about any of my slides in particular.
I think you said that the US economy is not in a recession yet. No? You have a lot of voices that say it is.
Or it just about is. Yeah. And maybe they're right, but the evidence doesn't stack up yet. The evidence is there. We just saw it today. By the way, very interesting. So people just don't anticipate how this works, right? there are people that have studied, they're always experts in the last crisis, and they have this lens. This is how the world works, and they take that lens and boom, they stick it on today. This is so they know so much about the housing crisis model, and that they're looking at this at the same lens. We've seen U.S. mortgages reset from 3% to 7%. For 2 years, you had the chance to reset your mortgage to rock bottom levels in the U.S. And most Americans are sitting on that rock bottom mortgage, and as long as they don't have to move, they're happy campers. And they don't want to move, because if they move, that means they have to buy a new house, and the mortgage is going to go up. So if nobody's selling, there are no new houses available. There are no existing houses available to buy. We just saw the U.S. housing starts just rocket up. It was so-called 10 sigma plus surprise on new housing starts from the U.S. today. If you need to move, you have to buy a new house. There are no other houses available. So housing activity, the idea that this freakish rise in the mortgage rate was going to kill the U.S. housing market, ironically, it's creating now a housing boom, at least in new homes. So you have some of these home builders, instead of being crushed under the bus, they're actually trading at all-time highs. And those are the types of, you have to look around the whole system, around the way the whole thing works. It's because the U.S. homeowner is not leveraged. Back in the housing crisis, they were leveraged. They were being offered teaser rates. Pay 1% now. Yeah, it'll go up to 5% next year, but it's 1% now. That was so that the investment bank could get its crappy mortgage stuffed into some derivative and sold to German savers who had no clue. It was AAA. This time around, there's no leverage in the U.S. housing market. So it's a different market. It's not the last cycle. And this is the kind of, I didn't know that beforehand, but this is the kind of stuff we discover as things go along. This cycle is not the last cycle. Yes.
Yes. Could you share some of the philosophy and strategy behind the Saxo Select FX?
If I knew something about it, I would. I'm embarrassed to say I know of Saxo Select, but I'm not involved in that product at all. So I have to plead ignorance. But I can get somebody to, if you want to reach out to Casper, and I'm sure he'll get you the right place to get some more information. You've got me blushing up here. Sorry about that. My role is just looking at the markets and trying to figure out what's going on. I'm not really involved much on the product side. Sorry. Yeah, go ahead. Sorry, there was a question over here.
With regards to the US dollar, do you think the new BRICS currency movement is threats?
No. No. I think the only threat to the US dollar comes when something hits this whole when we're on the other side of this whole reset. And what does that look like? I don't even know. It's so big. I don't even know what this looks like. How do you take a BRICS currency and redenominate $80 trillion worth of assets, 2 times global GDP? And I'm not a big fan of BRICS anyway, especially South African. They can't even keep the lights on in South Africa. It's hard to. It's just of course they're interested. They're the trade relationships and financial relationships otherwise related to especially to China, but also India. So I don't see any credible until we've seen the whole smoking ruins of whatever this is, however this sort of devolves. But alternatively, that could be triggered by a very, there was even a little, sorry, I'm jumping all over the place, but there was even a little snippet I didn't discuss on one of these slides. An inward turning U.S. So an inward turning U.S. that doesn't want to service this system anymore. That stops opening up all the swap lines constantly. But then you're also talking about just something being reset, and then you can look towards it. There's not like a transition point to something now. There has to be this old system. I think has to become the old system, and something new has to start emerging before I can see any clarity on answering that question competently for some long time horizon. I hope that. I'll take.
Obviously, we've seen the end.
Yeah.
Not on the goals of the budget plan. Do you think they'll just do verbal intervention for a long time to see how effective that is?
Well, they do intervention, but it's just lousy. It's just lousy quality. The market, it's such a horrible thing to observe because the market is usually way bigger than their intervention, and everyone's kind of fearing it. And then you have a driver that's actually saying, you know, it should be trading higher dollar yen, but we know there's intervention. There's this weird dance, and they intervene, and then everyone jumps on it. They intervene. Now we can drive it higher. I'll never forget back in 2003, I believe it was, when I was cutting my teeth on FX, that the staggering quantities they were throwing at the market. I think it was $180 billion of intervention they did, and it held it for a few months and then it collapsed through. Same with the Swiss franc. So, not sure what your question was, but I think they'll be happy to intervene when it gets disorderly, the fall or the rise in the yen crosses, the fall in the yen. It's just not effective. They have to shift on policy, or the market has to shift. If we're going to go, if I'm wrong here, and then we go screaming into a recession and global rates start collapsing, then the Bank of Japan, and we've been saved. They don't have to do anything. They finally waited it out. I just think it's unlikely. I think something's going to force their hand.
Do you think there's any, sorry, do you think there's any threat to, at the moment it's okay, but do you think there's any threat to the US dollar Hong Kong peg?
It's a $1 trillion question, yeah. I at some point, yes. But that's this slide again. Hong Kong is the interface to the global financial system from China. So it's existential for them to keep things unchanged. You saw pressure on it quite bad last year. They drained, was it 20%-ish of the reserves in very short order to defend the peg. I think a lot of these FX swaps are held by China, but it's too murky. I don't know. But it'll be defended to prevent disorder and to preserve financial linkages unless there's, and I'm not predicting, I'm saying unless there's some kind of profound break, and that's just not in anybody's interest. For this fragmentation, that both sides are happy to see it proceed. They see it in their national interest to see the fragmentation proceed, but they want to see it proceed in an orderly fashion, because China knows what happens if it does a Russia, right? That's too disruptive. The dollar is a weapon. It's a very high-grade weapon as well as a fact of life for global financial markets. So, long story short, it's a risk. What delta do I put on it? 10 delta over a 1-year horizon. It's the best I can offer. Sorry. I think there was a question next over here. I'll take you in the white shirt. Sorry, first the button-up shirt.
Going back to the US dollar.
Yeah.
I don't personally see any currency moving away from the US dollar. Do you think there's a possibility of moving towards a multi-currency market on a global level, just like we're seeing with
Under fragmentation, I see the opposite as being the case. Now, if there's if all sides see the light and want to go towards that, perhaps, but I don't see the. You have to have a more harmonious world that's not fragmenting. You have to have a world that wants to all sit down and be happy and work together on something. That's not the world I see right now. I see a fragmenting world that's building dams and making sure things are fungible. But I hope you're right. It'd be much better. But then you need to reset all this stuff again. And what? Yeah. So I agree on the dollar that there's nothing there yet. Over here, yes, sorry.
Well, calling it the dollar, the US dollar, is actually no. But we'll leave that alone, that's history. The thing is, you're seeing central banks around the world, the Federal Reserve, I'll do a Bernanke helicopter money, quantitative easing 1 or 2 TARP. All these different things come out and basically value long-term of currencies when you hit them that hard. What I'm saying is, what's a timeline of fiat? Because now more and more in the open conversation here is CBDC, and you have for great reset purposes. Entitlements coming up to the point of no return are 230 or earlier. So once the longevity, like you may call it a dollar, you may call it whatever you want, but as a fiat currency, it may not exist in 10 years. So what's the chances?
I see CBDCs as a better way to do fiscal. as a bigger transition to fiscal dominance, away from monetary policy dominance. In other words, let's say we have the next crisis, everything goes to crap, there's another pandemic. There was such poor organization in the U.S. during the pandemic on how to get support into the economy. You know, everybody gets a check. Everybody needs. You need a loan, and you create some fake business. There was hundreds of billions of dollars of fraud, wholesale fraud in the U.S. It didn't matter. They just needed to get money into the economy. With a CBDC, you have everybody's social security number. You bank directly with the Fed. You have that deeper integration of the Fed. So I actually have a deepening of the fiat system, not an end of it, in that situation. Unless we are able to go libertarian and all start trading on blockchain and cryptocurrency. So I see CBDCs as a policy arm of deepening the ability for them to fine-tune fiscal dominance, fine-tune stimulus where it's needed, to make sure that the unbanked have a bank account so that they can get aid directly to people rather than some chaotic distribution system.
My point,
So I don't see the end of fiat. In other words, I can see the.
well, I hope there's not an end to fiat.
But you bring up a great point. And that point is the entitlement dynamics that cannot continue forever. That's the one thing the great Stanley Druckenmiller was out bemoaning recently in a long interview. Corrected. You cannot have. This cannot happen. The real costs of entitlements cannot just continue to go up forever together. It can't. It cannot. So if it cannot, it won't.
Are spending money like Trump and said was on liberty.
Yeah, it can't because it won't. And it's also the weakness of democracy, because we all want to vote into power more money for ourselves. But if this is what it results in, then we eventually bankrupt ourselves. So eventually the real value of these projections have to stop rising and they must fall. Social Security payments will have to fall in real terms. Medical care will have to cost less in real terms, et cetera, all down the line. How do you get there? You get there with a higher nominal growth rate than the interest you're paying. You get there by capping yields, but forcing people to save their money in U.S. Treasuries anyway. Financial repression is how you get there. And people say, well, I want to take my money somewhere else. Then you do capital controls because you can't take your money somewhere else. You're not allowed to. So financial repression, that's a very tough one. That's a very tough investment environment, financial repression. And then we need to really be careful with where we put our money. It's going to be in real hard assets, commodities. It's going to be in companies that can maintain pricing power. But you're touching on some existential points that are critical to consider for sure. Is the last question? Yeah, I'll take one last one. If somebody. I'm sorry. Were you raising your hand every time? Sorry. I'll take two questions.
Are we going back in history, investing in commodities? We are talking about gold, diamonds, and water. Water is going to become a component.
Yeah, water is a very critical resource.
Exactly, and water is going to be more expensive than anything else in the future.
Yeah, I have my hopes for.
Actually, say if you invest in water springs, in buying water, that is probably going to be more expensive than gold. But in the past, one was investing in gold. Gold, diamonds, blue diamonds.
Things that hold their hard value for sure. Water is very important. I have my hopes for some very efficient. There's some very interesting things on the desalination front that are very efficient. So, we'll take the last question back there just to be polite since you had your hand up. No? Okay.
You started with your story. You said it's a lot of unpredictable data, a lot of very confusing data. You see an inverted yield curve. You saw the S&P 500 going up 23%. I think a lot of us, also here myself, and just an investor and a lot of our clients here, what will be now? What is what will you be looking at for the next 6 months? What is the data set?
Yeah. So
keep an eye out on this to know where we're going. We're going to go another 10%. We're going to go down.
I'm the last person that can predict stock markets, but I will say that we can get a continuation of Goldilocks, which would be gently softer data, nothing that raises concerns, but it allows the sort of the Fed projections and the tightening projections to continue to come down. Hopes that inflation will continue to come down. That's going to continue to drive the markets higher in that scenario. Or bad news is bad news. The economy maturely weakens, and we remember that recessions are bad for profits, and we have the typical recession playbook that is fairly typical back in market history. And then there's the reacceleration one. And I think, ironically, the equity market would not do that well in a reaccelerating economy because I think that will shock the long end of the yield curve higher. And that is very unfriendly to asset prices. So stocks would underperform in that relative to what they've been doing lately if we get a reacceleration in the crisis. And our bias right now is to believe that we have more significantly more tightening to come before they're getting ahead of this inflation. And that inflation is here to stay on a higher plane than it has been in previous cycles. So sorry for going on a bit. I hope that's.
I want to have a big applause for John. Thank you so much.